Imagine a company whose own auditor has said every single year for 6 years running, "We're not sure this business can keep operating." Now imagine that company is still listed, still trading, and still opening new restaurants. That's Katrina Group, ticker 1A0 on the Singapore Exchange, the company behind Bali Thai, Sofo, Streets, and the ST Signature co-living hotels. Today, we're going to open up 6 years of annual reports, run the numbers, and answer the only question that matters. Is there any version of the stock worth buying, or is it exactly as risky as it looks? Let's get into it. Here's our roadmap. First, we'll break down how Katrina actually makes money, restaurants and budget hotels. Second, we'll ask whether it has any real competitive moat. Third, we'll go through 5 years of financials, including the balance sheet problem. That's the whole story here. Fourth, we'll look at the one growth bet management is making right now. Fifth, we'll go through the risks, and there are a lot of them. And finally, we'll land on a valuation and a clear verdict using our JC Fund framework. Let's start with the basics. Katrina Group started life as a Nasi Padang hawker stall back in 1993. Founded by Alan Goh, and it listed on the SGX Catalyst board in 2016. Today, it runs 20 restaurants across Singapore, plus 5 co-living hotels under the ST Signature brand. Last year, the group did about 46 million Singapore dollars in revenue. And here's the number that tells you everything about the risk profile. The entire company is valued at just $6.5 million. That's not a small cap, that's a micro cap, and a genuinely distressed one. The business itself is simple to understand. Katrina runs 2 segments. The first is food and beverage, about 72% of revenue. Restaurants like Bali Thai and Streets, where you pay for a meal, and Katrina pays for ingredients, staff, and rent. The second is hospitality, about 28% budget co-living hotels that rent rooms to students, work pass holders, and tourists. Neither segment has any real pricing power. Both are exposed to the same 3 cost pressures every Singapore F&B operator faces: rising wages, rising rent, and rising competition. Katrina isn't one restaurant. It's a small portfolio. Bali Thai, Sofo, and Streets are the core-owned brands. Tomo Tokyo and Sancho's are newer additions. And then there are the licensed brands, Daily Beer from Korea and, as of February 2026, Lateria, a Korean-Japanese burger chain, with its first Singapore outlet at Jewel Changi Airport. Notice the pattern. Katrina pays other companies for the right to use their brands. It doesn't collect franchise fees from anyone else. That tells you something about its bargaining power in this industry. Breaking revenue down by segment over time tells a real story. F&B revenue has fallen from $41 million in 2021 to just $33 million last year, as the restaurant count nearly halved, from 34 outlets to 20. Hospitality revenue peaked at $17 million in the post-COVID tourism boom, and has now fallen back to $12.7 million as competition in Singapore's short-stay accommodation market intensifies. This isn't a growth story. It's a shrinking company trying to find a floor. Every consumer stock gets asked the moat question, and for Katrina, the honest answer is no. These are mass-market, non-premium restaurant brands with no pricing power and near-zero switching costs. A diner can walk to any other restaurant with zero friction. There's no scale advantage either. The outlet count keeps shrinking. And on the hospitality side, the one thing that looked like an edge, the co-living hotel model, is now the subject of active government litigation, which we'll get to. If anything, regulation here is a risk, not a moat. Now the numbers. Revenue has fallen from $54.7 million in 2021 to $46 million last year. Net profit has swung wildly, a small loss in 2021, a $3.5 million profit in 2022 as tourism reopened, a loss in 2023, a profit in 2024, and back to a $2.8 million loss in 2025. This is not a business compounding steadily. It's a business lurching between profit and loss almost every single year, with no clear upward trend. Here's a number that should stop you before you go any further. Katrina's shareholders' equity has been negative every single year since 2020, 6 years running. Last year, it stood at negative $6.6 million. And Ernst Young, the auditor, has attached a material uncertainty related to going concern warning to every one of those 6 audit opinions. The company survives on an informal, rolling 15-month promise from the founder and his wife not to call in the money they've lent the business. That is not a committed bank facility. That is a family keeping the lights on, one renewal at a time. The most recent full year confirms the trend is not improving. Revenue fell 16% to $46 million. Both segments got weaker. F&B's adjusted profitability actually turned negative for the first time. Hospitality's adjusted earnings fell by more than two-thirds, from $2.6 million to just $800,000, as management itself cited rising competition. The company swung from a $2.3 million profit in 2024 to a $2.8 million loss in 2025. There is no analyst coverage on this stock, so there's no consensus to beat or miss, but against management's own cautiously optimistic tone a year earlier, this was a clear step backward. A word on who's running this. Alan Goh has led the company since founding it, more than 25 years in the industry, and he's joined on the board by his wife, now a senior advisor, and, as of August 2025, his daughter, who took the executive director's seat her mother vacated. Combined, the family holds a deemed 81.7% stake. Public float is just 17.8%. And remember that going concern support letter from the last slide? That's the same family. When one family controls the board, the majority of the shares, and the mechanism keeping the company solvent, that's about as concentrated as governance risk gets. So where's any actual growth coming from? One place, Lateria. In August 2025, Katrina signed a franchise deal with Korea's Latte Jars to bring the Lateria burger brand to Singapore, and the first outlet opened at Jewel Changi Airport in February 2026, a smart, high-footfall location. It's a real initiative, and airport retail is a sensible bet. But management hasn't disclosed a rollout target, a payback period, or unit economics for this format. Right now, it's one outlet. Everything else is strategic hope. Let's be completely clear about what could go wrong, because there's a lot. The going concern support could simply not be renewed. ST Hospitality, the unit behind the co-living hotels, received an actual court summons in mid-2025 under Singapore's Planning Act, and no financial provision has been made because the company says it can't estimate the damage. There are 213 million warrants outstanding, 85% of the current share count, mostly held by the controlling family, which could dilute public shareholders further. And Singapore's minimum wage floor for food services rises again in July 2026, adding more pressure to a cost base that's already squeezed. On paper, Katrina trades cheap. Its enterprise value is about 0.6 times sales, versus Kimley at 1.8 times, Old Chong Kee at 1.1 times, and Jumbo Group at 0.9 times. But that discount isn't a bargain, it's a distressed discount. The two SGX-listed peers actually closest to Katrina's situation are Japan Foods Holding and Sakai Holdings, both also loss-making, both also trading at depressed multiples. Cheap on a multiple means very little when the company beneath it has negative equity and an active lawsuit. So what's this actually worth? A standard discounted cash flow model puts fair value at roughly 2.3 cents a share against a current price of about 2.6 cents. So the market isn't pricing in some wild recovery story. It's pricing in something close to our own base case scenario, modest stabilization, Lateria adding a bit of growth, no disasters. But because book equity is negative, we also ran an option-style model that treats the stock as a bet on the company's assets recovering above its liabilities. That model implies the market thinks there's roughly a 72% chance this doesn't end well within the next 2.5 years. Running this through our full framework. As a dividend growth stock, it's an automatic fail, 0 dividends paid in 6 years and negative equity throughout. As a global growth stock, also a fail, revenue is shrinking, not growing at anything close to what that framework requires. As a tactical options trade, it's not even executable. There's no listed options market on SGX, so you can't even hard cap your downside the way that strategy demands. Put together, and the honest verdict is avoid or at most a nominal position size for a complete loss, not a real allocation. So here's the bottom line. Katrina Group might have a real turnaround story buried in here. Lateria could work. The litigation could resolve quietly. The family could keep the lights on indefinitely. But might is doing a lot of work in that sentence. And right now you're being asked to underwrite 6 years of negative equity, an active lawsuit, and total reliance on one family's goodwill for a stock most people have never heard of. That's not investing. That's speculating. And there's nothing wrong with that as long as you know which one you're doing. If you found this breakdown useful, hit like, subscribe for more deep dives like this one, and let me know in the comments, would you touch a stock like this? And as always, this is not financial advice. Do your own research before you invest.